Welcome to the deep dive. Today, we're plunging into the world of the limited liability partnership, the LLP.
Yes, the LLP.
You know, that business structure that tries to blend the protective shield of a company with the operational freedom of a traditional partnership.
It's become really popular, hasn't it? But understanding its financial health, that's the key.
That's the critical question, exactly. Because while LLPs offer that flexibility and they are legally separate from their partners under the LLP Act 2008,
Right.
clear financial reporting, well, it's not optional, is it?
No, absolutely not. Transparency is crucial.
And that's precisely why we're pulling apart a really important document today. It's the guidance note from the Institute of Chartered Accountants of India, the ICAI.
Specifically on the financial statements of LLPs. Yeah, this is a big one.
Think of this guidance note as like the essential map for navigating LLP financial.
It sets out the rules of the road, doesn't it?
Yeah.
To make sure these statements are, well, accurate, comparable, and reliable for anyone looking at them.
So, our mission in this deep dive is to unpack this map for you. We want to understand what actually goes into these financial statements, why certain things are disclosed in specific ways.
And maybe uncover some surprising details hidden in those notes.
Exactly, because it does make you wonder, for a structure that's known for its flexibility, why the need for such detailed, standardized guidance?
What is it about this sort of hybrid form that demands this level of structure? It's a good question.
Let's start right there. What is an LLP, according to this guidance note?
Well, the source defines it very clearly. It's a body corporate,
Body corporate. Okay.
which means it has its own legal identity, separate from the partners. That's where the limited liability comes from. The LLP's debts are generally its own, not the partner's personal debts.
Yeah, but it keeps that internal flexibility of a partnership agreement, unlike a company with shareholders and, a rigid board structure.
Precisely. But that body corporate status
Right.
brings obligations under the LLP Act. Every single LLP has to maintain annual accounts. And these accounts need to show a true and fair view of its financial state. Plus, every year, they must file what's called a Statement of Accounts and Solvency with the registrar.
So there's this built-in requirement for disclosure, for accountability, even with that internal flexibility. But how do we make sure true and fair means the same thing everywhere? So you can actually compare LLPA with LLPB.
That's where accounting standards step in. They're indispensable. The guidance note really hammers this home.
The foundation right now.
Exactly. Think of them as the standardized language of business. They ensure high quality, transparent, consistent, and crucially, comparable financial information.
Without them, it'd be chaos, right? Everyone doing their own thing.
Total chaos. Comparisons would be impossible. Understanding them, incredibly difficult.
Okay, so accounting standards are the language. Which ones are LLPs speaking now?
So currently, LLPs use the accounting standards prescribed by the ICAI for non-company entities.
Non-company, okay.
But, and this is important, the note mentions a big development. The 2021 LLP Amendment Act gave the government power, working with ICAI, to prescribe specific accounting standards just for LLPs down the line.
So tailor-made standards might be coming.
That process is underway, yes. It's something to watch.
Now, here's something that jumped out at me. The note stresses that compliance with the current standards isn't just, like, a suggestion.
Oh, absolutely not. It's mandatory, non-negotiable.
And who's responsible?
The LLP's management. They're on the hook for ensuring compliance.
And if they don't comply, if they deviate,
Then the auditors have to flag it, clearly, in their audit report. It's a big red flag for anyone reading those statements.
a warning sign saying, hey, look closer here.
Precisely. Something's not standard.
Okay, auditors, let's talk audits. Does every single LLP need one?
Not quite every single one. The LLP rules from 2009 set out thresholds.
Thresholds, right. What are they?
An LLP is exempt from a mandatory audit if its annual turnover doesn't go over 40 lakh rupees.
Okay, 40 lakh turnover.
Or if its contribution, which is basically the partner's capital, doesn't exceed 25 lakh rupees.
So either turnover or capital size keeps you under the mandatory audit radar.
Correct. If you're below both of those, you're generally exempt.
But what if they're below those limits but want an audit? Maybe for credibility.
They absolutely can, but partners can choose to have a voluntary audit. There's nothing stopping them.
And if they do opt in,
Then it has to be done properly, following all the rules, including the auditing standards from ICAI. It adds that layer of assurance, even if not legally required.
makes sense. Okay, structure, standards, audits, check. Now, the actual reports. What makes up an LLP's set of financial statements according to this guidance?
So the source lists the core components. You've got the balance sheet,
Right, the snapshot.
a statement of profit and loss.
Performance over time.
The cash flow statement, though, as you hinted, there's a catch there.
Yes, the caveat.
And really importantly, the notes and other explanatory stuff, these aren't just tacked on, they're integral, vital.
And the overall point of all these?
To give a full picture, balance sheet, financial position assets, liabilities, P&L, performance income, expenses, cash flow, where the cash went.
Now, that cash flow statement caveat, you said it's not always required. That seems linked to that flexibility idea again.
It is, and it's a key difference the note highlights. Smaller LLPs don't have to prepare one.
Smaller ones, how are they defined here?
They fall under the ICAI's classification for non-company entities, levels 2, 3, and 4. These smaller guys are exempt from the mandatory requirement for a cash flow statement.
They can still do one, though.
Oh, yes, and it's encouraged for better transparency. But it's not an obligation for them. It shows how reporting can scale with size.
Interesting. Okay, let's dive into the big ones, the balance sheet. What's its main job and any LLP quirks?
Well, it's that snapshot in time. Assets, liabilities, and what the guidance calls partners' funds.
Partners' funds, okay.
Structure-wise, it's pretty similar to a company's classifying things as current or non-current based on, the operating cycle or 12 months.
Right, but partners' funds instead of equity. Why the specific term?
Good question. The guidance note uses it deliberately. Unlike a company's clear share capital and reserves, an LLP's capital structure can be more fluid, often defined by the partnership agreement itself.
So it's a broader term.
Yeah. Some items under partners' funds might not fit the strict accounting definition of equity. So this term is seen as a better reflection of the partner's actual stake and how it's structured.
Okay, let's unpack that further. Because the notes related to partners' funds, wow, they require some serious detail.
This is where you really get a peek behind the curtain. The guidance mandates incredibly specific disclosures for each individual partner's accounts.
Each partner, really?
Yep. For every partner, you need to see their opening capital balance, any contributions they made during the year, any remuneration or interest the LLP paid to them,
Okay.
any money they withdrew, and their specific share of the profit or loss for the year. All broken down, partner by partner.
Wow. So you can track the financial flow between each partner and the LLP. That's way more detail than you'd ever see for individual shareholders in a public company's reports.
It really is. It tells you a lot about how the partnership actually operates financially. Are partners putting money in, taking it out? Are profits kept in the business or paid out? How are things like salary and interest impacting individual partners?
What could that tell you, say, if you were looking to invest or lend?
It could show stability, maybe partner commitment if capital is steady or increasing, or it could flag potential issues if one partner is drawing way more than others compared to their stake or the profit share. It gives real insight into the internal dynamics.
That's powerful, very specific. Are there other standout details required in the notes, things that surprised you?
Definitely. Another one that's quite specific is around trade payables.
Money owed to suppliers?
Yes, but specifically suppliers covered by the Micro, Small and Medium Enterprises Development Act, 2006, the MSME Act.
Huh. Why single out those particular suppliers in the financial notes?
Because that act has rules about paying these smaller businesses on time, and penalties, like interest, if payments are late.
Ah, I see. So the notes have to reflect compliance with that law.
Exactly. The guidance requires LLPs to disclose the total amount they owe to registered MSME suppliers, any interest they still owe on late payments, any interest they paid during the year for past delays.
Okay. Unpaid amounts, past interest paid.
The amount of interest that's due for the current period's delays, even if it's already been paid, and critically, the interest that's accrued but still unpaid at the year end.
So the financials basically become a compliance checklist for paying small suppliers under this act.
In a way, yes. It puts it right there in black and white. For a lender, it flags potential hidden liabilities for unpaid interest. For other businesses, especially MSMEs thinking of supplying this LLP, it's a clue about their payment practices.
Mandated transparency directly linked to regulatory compliance. Very clear connection. Okay, let's switch to the other main report, the Statement of Profit and Loss, the P&L.
Right, the P&L. This tells the story of performance over a period, usually the financial year.
Income and expenses.
Pretty much. It shows revenue from operations, adds any other income, and then lists out all the expenses. The bottom line is the profit or loss.
Are there specific expense disclosures in the P&L notes that are particularly revealing for an LLP? Maybe related to that unique structure?
Yes, definitely. Just like the balance sheet notes gave us insights on partner capital, the P&L notes reveal cost structures, for instance, under finance costs.
Interest expenses and such.
Right. But the guidance says you can't just lump all interest together.
Yeah.
It specifically requires disclosing interest on partners' capital separately from other interest costs, like, say, interest on bank loans.
So you see the cost of using the partner's own money versus the cost of borrowing from outside.
Precisely. It separates the return paid on internal partner funding from external debt costs. It highlights that unique aspect of LLP funding.
That's a neat detail. Anything else on expenses?
There's another interesting rule about significance. Any single item of income or expense that's pretty large,
How large?
specifically if it's more than 1% of the LLP's revenue from operations or are over 1 lakh rupees, whichever is higher.
Okay.
It has to be disclosed separately in the notes.
So no hiding big, unusual items in vague categories.
Exactly. It forces transparency on individually significant transactions or cost drivers. Whether they're one-offs or major ongoing things, users get to see their impact clearly.
And the P&L structure itself, does it reflect the LLP form?
Often, yes. The formats suggested in the guidance show profit calculated at different stages. They explicitly deduct things like partners' remuneration and that interest on partners' capital before you get to the final profit figure that's, available for distribution or subject to tax.
So it clearly separates the profit generated before partners take their share as salary or interest.
Correct. It maintains that visibility. It reflects the partnership ethos, showing what the business earned before the partner's specific returns are taken out, which is different from how employee costs or dividends work in a company.
Makes the flow of funds very clear. Now, we mentioned earlier that not all LLPs report exactly the same way. Can you elaborate on that? The classification system.
Right, the proportionality aspect. The ICAI classifies non-company entities, including LLPs, into 4 levels. Level I is the biggest, level 4 the smallest.
And this is based on?
Primarily turnover and total borrowings. Size and financial scale, basically.
Okay, so levels 1, 2, 3, 4. How does being in a certain level change the reporting rules?
Well, the guidance note explains that smaller LLPs, typically your level 2, 3, and 4 entities, which often align with MSMEs.
Micro, small, medium enterprises.
Right. They get certain exemptions or relaxations. They don't have to comply fully with every single requirement of all the accounting standards.
Why do that?
It's pragmatic. It reduces the complexity and the cost burden for smaller businesses where maybe super detailed disclosures aren't as critical or feasible.
So those exemptions tie back to things like the cash flow statement.
Exactly that. As we said, cash flow isn't mandatory for levels 2, 3, and 4. That's a prime example of such a relaxation.
Are there others?
Oh, yes. The appendices in the guidance note have tables laying it all out. They show which specific paragraphs or disclosure requirements within various accounting standards are eased for each level. Usually it's more about simplifying the notes rather than changing the fundamental way they recognize income or assets.
So tailoring the burden, that seems sensible. Balancing transparency with practicality. Okay, stepping back then, what's the big picture impact of this new ICAI guidance note?
Standardization. That's the headline. By giving clear formats, detailed instructions, it massively boosts the quality, the transparency, and really importantly, the comparability of LLP financials across the board.
So less variation than before.
Definitely. Now, if you look at statements from 2 different LLPs, you should have more confidence they're built on the same foundation, using the same rule book. It makes analysis much, much easier.
And this specific guidance note, effective for periods starting April 1st, 2024, replaces the older technical guide.
That's right. It elevates it from just a guide to more formal guidance, giving it more teeth, ensuring that consistency.
Okay, so we've done our deep dive into the ICAI's guidance on LLP financial statements. We've covered what an LLP is, why standards and audits are key, the main report's balance sheet, P&L.
And we got into some of those really specific, interesting details in the notes.
Yeah, like that granular detail on individual partner accounts, the MSM 80 Act reporting for suppliers.
And separating out costs like interest on partners' capital. These things really give you a window into the unique workings of an LLP.
And we saw how the LLP's level adjusts the reporting load, simplifying things for smaller players while keeping essential transparency.
Ultimately, this standardization is vital for lenders, potential partners, suppliers, anyone needing to gauge an LLP's financial health and how it operates.
Absolutely. So here's a final thought to leave you with. Considering that mandated detail, especially around partners' funds and things like the MSM Act compliance, How does that level of transparency actually shape trust?
Mm.
If you were thinking about joining an LLP or lending to one or doing major business with one, what unique insights could looking closely at those specific notes, the partner movements, the supplier payment record, give you about the real integrity and the day-to-day reality of that business? Something to think about.